everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And we are in that part of our running macro story where we go back to China. This, of course, has been a major narrative for global markets in recent months. In December, China seemed to get religion on COVID policy and decide, you know what, these very restrictive policies that we had in place, these zero COVID policies, where in the extreme versions, somebody in an apartment building gets COVID, the entire apartment building is then stuck indoors, locked down, just so it doesn't spread. Those policies in December were suddenly abandoned. Part of it may be aggressive protests in China and an interestingly responsive Beijing to that kind of thing. They don't typically spend a whole lot of time paying attention to that kind of thing, nor allow it. But clearly here, there's been something of a reaction function. Certainly the withering on the vine of the economy was almost certainly a part of that narrative. And there's been a tremendous amount of optimism in markets around this change in policy, having the second largest economy brought back into the fold, brought back onto the global stage, and boosting global growth as a whole. And so it's only right that as we look ahead to some critical economic data out of China in just a few hours here, we ask, is the reopening going well? What's going to be on tap for this data? What's it going to tell us about this reopening? Does this optimism have any sort of legs to stand on? And in that, we will sort of look at activity data, look at what Chinese inflation seems to come from, and get a sense for what this number might be, what it might tell us, and most importantly of all, how markets might interpret it. Not just for Chinese assets, not just for related assets, but market-wide and across asset classes. So the first thing we're going to look at here is, of course, baseline expectations. So we're going to get the CPI number here. The expectation will be that we rise a hair, that this will be the second consecutive monthly rise if expectations hold up, looking for a rise up to 2.1%. Now, looking at the picture here overall, this does not look like a tremendous increase. Sort of looks like a rise within the bounds of where we've been recently. Contextually, we would, of course, expect a pickup in CPI if economic activity is, in fact, getting more robust against the backdrop of a reopening of the economy. More economic activity means more money is changing hands. More money changing hands means the velocity of money is rising. That tends to be inflationary. So if we get a number here that's in line with expectations, maybe we don't get much of anything. But if we get a number that's north of those expectations, that might give us a sense that indeed this recovery is maybe getting a little bit of steam behind it. If we get a number that's softer than expected, you would, of course, expect to see the opposite. Looking at where the market thinking has been, there's certainly been a dose of optimism that has been injected here. So the yellow bars you see there are the Citigroup Economic Surprise Index. Those of you that have been watching Macro Money know I love this series of indices for the various economies. It tracks the performance of economic data, not in absolute terms, but relative to median forecasts, relative to what economists writ large thought was going to be the outcome. And what you see here really as we go into January is that economic data out of China has started to outperform forecasts, and not by an insignificant margin either. And against that backdrop, we've also seen a meaningful revision in GDP forecasts for this year. We can see we've gone from about 4.8, let's call it, year-on-year GDP growth to about 5.1. That's maybe not immediately eye-catching. It's only a 30 basis point change. But when you multiply that 30 basis points across what it would mean for an increase in the world's second largest economy, we're talking about quite a significant lift here. It is, of course, also, you can see visually by looking at the sort of darker line there, the signal for a sort of change of heart amongst market participants. It seems like they are now much readier to envision this China rebound actually having some sort of steam. You can see the expectations for next year are still relatively anchored at 5%, but the dip lower that we saw in the back half and in particular the fourth quarter of last year, that seems to have abated. So a little bit of an improvement there also. So perhaps there is scope for this CPI number to give us something that's a little bit better than expected. Perhaps these expectations of a 2.1 rise are still being weighed down, as the yellow bars would suggest, by economists' models that are still forecasting more weakness than reality has ratified for now. And therefore, maybe there's room for an upside surprise, which then suggests a stronger Chinese recovery, which lifts market spirits broadly, not just in China, but certainly across the APAC region, from there into Europe, which is a tremendously close economic relationship with China, Germany in particular, and Germany, of course, also the largest economy in the Eurozone. And then into U.S. markets, which, of course, have a tremendous relationship with China as well. However, not all is as rosy as it seems. We've been looking at high-frequency data to get a sense for where this economic pickup might actually show up in economic activity on the ground, without actually, of course, being on the ground. And one way that we've looked at it is volumes on the Shanghai Hong Kong Stock Connect. This is essentially a setup where if you have access to stocks in Hong Kong, you can buy Shanghai listed shares directly. So too, if you have access to the Shanghai exchange, you can buy shares listed in Hong Kong directly. What this does is it gives mainland investors an outlet into global markets, and it gives global markets an outlet onto mainland share bourses. So you have essentially here a sense for money flows reflecting, on the one hand, some pent-up demand from Chinese investors coming out of lockdown, and on the other hand, some pent-up demand from global investors looking for China to have its economy revitalized by this reopening. The striking thing, of course, is that volumes on this connect are not picking up in any kind of way that would suggest robust reopening is underway. We've certainly seen large swings in here. We're looking, by the way, at the 20-day moving average just to get a better sense of the trend. You can see that we're really still kind of stuck where we've been most of last year, just kind of oscillating and treading water. So if what you were looking for was for investors to put their money where their mouth is, directly into assets on mainland and in Hong Kong, going both ways, northbound and southbound, doesn't appear to be there, at least not yet. Another high-frequency indicator, metro traffic in the top 5 cities in China. This is where the big population centers are. And again, if you were to have a situation where there is a mass economic reopening, and you were to have a situation then where more people are moving around, economic activity is starting to bubble, you should see a pickup. You should see more. And we're still below the median really for the past year. So we're still weaker than we've been through all of the lockdown period. We're sort of approaching the median again, but again, no explosion of people moving around in China's economic centers, of workers shuttling back and forth, of business people rushing to meetings, if you will. So this is not seemingly suggesting that the optimism that we're seeing in the GDP revisions and even in the flow of economic data, believe what you will about the veracity of Chinese economic data, I really don't like to get stuck in those conspiracy theories. I'm generally of the view that either the data is shaded or it's not, but either way, it's a policy signal, because either the data is real and it is telling us what policymakers are going to do, or policymakers are shading the data to show us what they're going to do. But either way, they're telegraphing what they're going to do, so really, does it even matter? But nevertheless, there is this disconnect. And so with that in mind, perhaps it might make sense to look at, well, where else could inflation come from? And where has it come from? What would alter the way that this number might print up or down? And what's the risk of a downside surprise? With that in mind, it's worthwhile to look at essentially imported inflation. Imported inflation would be a situation where the price of imported goods is going up, and that is lifting overall levels of inflation. Because if the basket of goods that your people consume, the one that CPI is based on, the Consumer Price Index, if that basket is getting more expensive because the imported parts of it are becoming more expensive, well, then that's a generalized rise in CPI. So what we're looking at on this chart here are normalized input prices. So in other words, intermediate goods, the prices of things that generally go into Chinese manufacturing. China is, of course, sort of in the middle of the global supply chain, where what they bring to bear is abundant labor, or have brought to bear over the past, let's call it 30, 40, 50 years, is abundant labor that they then apply to massive commodity imports. China is at this point the number one importer and in many ways the number one processor of pretty much every major industrial commodity one can imagine, and not only industrial commodities either. I don't think you'd call soybeans an industrial commodity, but nevertheless, China is a massive importer and processor of soybeans. But certainly when we talk about iron ore and the processing of that into steel, let's say, that's a big, big thing here. So the first thing we look at is input prices. So those things that China imports to do its thing in the global supply chain. The second is an import price index. China, among other things, imports a massive amount of the food that its consumers take in. And so that would be those soybeans and various other things. For example, milk powder. So there is a significant relationship here, clearly, with CPI, which is those yellow bars in the back. And so you can see that if you lag CPI 6 months, because of course there is a period where the price of inputs or the price of imports move, and then that filters into overall price levels over some amount of time. So here it looks like the appropriate lag is about 6 months. So if we go and we pull CPI back 6 months, it lines up quite well here with what's going on with imported inflation. And then if we look at where imported inflation is then expected to go, it's down. So the expectation you can see there in the orange is for inflation to rise for a third consecutive month, and that very well may be. One number here or there does not make a trend. But it does seem like we topped on inflation as we topped on inputs and imports costs somewhere around the middle of last year. And so the path of least resistance for inflation might actually be down and not up. If we look at where those input costs come, just to really position this firmly in evidence-based analysis, you can see the gray bars there are the Bloomberg Commodities Index. So this is just the global cost of commodities across various categories: precious metals, industrial metals, softs, energy, etc. And I took a really big picture view here on purpose, so that you can clearly see it's not one thing or another. It's we've had deterioration in commodities prices from about the middle of last year, and that's been driving imported inflation lower in China. It topped a little bit earlier. It topped perhaps sometime in 2021, perhaps let's call it somewhere around the middle there. But nevertheless, the turn lower and the turn lower in commodity costs seem to line up. Going back to this chart here, what that then tells us is inflation may have peaked and is actually heading lower at this point because global commodity costs have turned down. And so what we're then looking for in this CPI number is a sort of interplay between, first of all, the pressure lower from this. Second of all, seemingly, if you believe the Chinese rebound and the reopening narrative is already creating a sense of economic vigor, then upward pressure from a pickup in domestic economic activity. Now, that pickup ostensibly, because of where China sits in the global supply chain, would come from a pickup in global demand. But that's not what this commodity story is telling us. This commodity story is talking about decelerating global growth, decelerating demand. And so it could be that actually this part of it is more dominant than any sort of reopening momentum. With that in mind, we look at where we are on global growth and where we are on growth in China. So the yellow bars there, Global Purchasing Managers Index, this is the composite, so it includes both the services and manufacturing sectors. And of course, as we've said many times before, but we'll repeat here again, for the benefit of clarity, the way that PMI numbers work is on a logic centered around the 50 number. So 50 is neutral. That is where the services and manufacturing sectors taken together, that's where economic activity there is neither growing nor shrinking. It's idling. If we go north of 50, so above 50, that would be the expansion of activity in services in manufacturing. If we go below 50, that's contraction of activity in services and manufacturing. The further you go up, the faster the expansion. The further you go down, the faster the contraction. So there's an element of speed there as well, not just direction. And so when you look at this, you see that we have been shrinking toward 50 on global growth, so slowing, really since shock of shocks, the middle of 2021, which of course is the time that the Fed starts the global tightening cycle, and we really begin this increase in the underlying cost of money, which of course then extrapolates out to absolutely everything, because before you make any kind of decision on what to buy, what to invest in, which business line to expand, which new factory to build, at the household level, whether you want the new appliance or the new car or you don't, all of that ultimately is a function of the cost of money. Can you afford it? And especially, can you afford to finance it? So we see that there's been, with the start of the Fed tightening cycle, a slowing in the global economy writ large. In the past 3 months or so, a bit of recovery. And you can see the very last yellow bar there is right around 50. So basically back to neutral, having spent a few months in contractionary territory. In China, along that same timeline, you can see a bit of a pickup, and the Chinese composite PMI number now at 51.1, so giving you a bit of growth. Critically, there doesn't seem to be a significant amount of catch-up. And maybe it's early days yet, but if you consider that this index also, as we just said a moment ago, telegraphs speed, you have to keep in mind that 51.1 relative to where we were on the downside, sub 40 as of the first half of last year, there's quite a lot of catch-up to do. And although we had a bit of a pop into the middle of last year, you can see there the peak around 55 and then the pullback lower, you nevertheless are not seeing this rapid reopening, for example, as you would if you looked at U.S. PMI numbers, the bottom of COVID, and then the subsequent months of reopening where PMI just absolutely soars because you get the catch-up growth. You're growing from a very low base, relatively speaking, and you get acceleration into catch-up back to normal as the economy reopens, because of course the slowdown is artificial when you lock down. It's not as if there's a slowdown just because people have stopped engaging with the economy. It's because there are policy-based restrictions on engaging. And if you take those away, there's usually a rapid burst of activity. At least that's what we've seen in the U.S. and in many Western economies, as the barriers to activity that wants to be there go away. Well, here we're not seeing that yet. It's very tepid so far. So the restrictions are gone, but maybe the appetite isn't there quite yet. And so you get a situation where commodity prices are fading, as we saw. That's coming against the backdrop of global demand that's a bit improved, but by no means robust and surging, even relative to relative recent months. And so maybe what you then end up with is a CPI number that misses because these global forces are still pulling down import costs and the price of inputs and creating this headwind. If that's the case, the takeaway for economic activity may well be, well, the China reopening isn't really as dynamic as we'd hoped so far. There's a downside surprise here. Maybe we need to revise down some of these growth expectations. Maybe we need to revise down some of the optimism built into broader markets around this narrative. Now, if the number is really abysmally bad, well, then we start to have a conversation about monetary policy. And as we see currently, as the reopening has progressed, the dotted line there, looking back at where China's yield curve was at the start of December, which is when the reopening occurs, and how it's developed since. You can see we are currently expecting a bit of front-loaded easing, actually, something to the tune of 25 to 50 basis points, and then a much shallower drive higher in rates than was previously expected. So even just looking at monetary policy expectations, we see a degree of weakness. Now, if the CPI number is really aggressively lower, much weaker than anticipated for all the reasons we've just discussed, It could be that the yield curve starts to price in still more easing. It could be that we get a little bit more of a shift at the 3-month, 10, or the 6-month, and we come down a bit. If that is going to be read by markets in a positive light, it could be, well, everybody is tightening, but the world's second largest economy is actually providing more credit and easing further. And that may be a source of optimism for future growth. But we'll have to see if the number is bad enough for the markets to extrapolate that far. As it stands, for how financial markets have thought about this reopening, the natural sort of inclination has been to look at how Chinese shares have formed. And here I'm looking at the ETFs, looking at the FXI, which is the iShares large cap China ETF, as well as ASHR, which is the X-Trackers ETF covering the broader CSI 300. This is the Chinese equivalent, essentially, of the S&P 500. This combines the Shanghai and the Shenzhen bourses into one thing, and is sort of the biggest, broadest look at Chinese shares. And as you can see here, they've been rising since November, and there's been a ton of optimism here, talking about, oh, well, the reason they're rising is this reopening. But what you see overlaid here are Fed funds futures expectations for where the Fed rate is going to be at the end of this year and at the end of next year. And you can see that as those expectations peaked, so too you got a generalized rally in risk. And of course, China would be on that risk spectrum. It would be somewhere on the risk-on side of the equation with stocks in general, but also with riskier, arguably, assets because of liquidity, because of volatility, because of policy risk, than, let's say, U.S. markets. And you see that you've had an outsized rise there, but of course, it appears to be Fed motivated rather than anything domestic, because it happens a full month before China even does their about face on COVID policy. What you see most recently is, of course, a repricing of Fed policy to a more hawkish setting. So you see in the very recent days an uptick in both of those green lines. And against that backdrop, Chinese shares wobble. They don't necessarily come down all the way. There's not necessarily a breakdown that's immediately discernible for now, but clearly the reaction function here is, again, on a risk-on, risk-off, Fed-motivated basis. So if we do get a weaker number here, the path of least resistance may well be to look at it in very simple terms and to say, well, this China reopening story, this is not the story that we're looking for. This is still a Fed narrative, and as long as that it remains a Fed narrative, Chinese shares look wobbly because it seems like the market is going in the direction of maybe the Fed needs to go harder, and indeed that yield curve has shifted for a peak a good 25 basis points or more higher than at the start of this month. And so looking at how the markets read this number and the significance of the Chinese reopening narrative in the broader story then hangs in the balance. And ultimately, the way the price action responds may be telling for the stability of risk appetite and the ability for risk appetite to build in the broader markets, but also to the extent that the markets even care about this China reopening narrative, when in fact it is the much more impactful, seemingly, Fed story that appears to be on the march. This has been Macro Money. I am Ilya Spivak, head of global macro with tastylive. We do this show just after overtime, Monday through Thursday, every single week. do come and join us for that. If you want to hear my various musings in between these shows, and of course overtime with our good friend Chris Vecchio, head of futures at Forex here at Tasty Live, you can follow on Twitter at Ilya Spivak. Good luck trading out there, folks. We'll speak soon. Take care. Godspeed.